For 50 years, the United States has held a quiet, strategic chokehold over the Canadian economy. On paper, this was just standard international trade in oil and gas. In reality, it was a geopolitical power play that most macroeconomics textbooks gloss over. Washington knew that Canada had the world's third-largest proven crude reserves, but they also knew Canada had a fatal flaw: geography. Canada was an energy giant, but it was landlocked. Almost every single barrel of oil produced in the Canadian oil sands flowed south into a single market. If you are a producer and you only have one buyer, that buyer sets the price. It's not a free market, it's a capture. For decades, this monopsony allowed the U.S. to buy Canadian energy at a massive discount, effectively subsidizing American industry while keeping Ottawa economically dependent. Washington didn't need to say it out loud. The leverage showed up in every trade negotiation, every softwood lumber dispute, and every quiet diplomatic phone call. But while the media was distracted by election cycles and tariff threats in late 2025, the map changed. In this video, we are going to unpack how a new logistical route out of Canada, an Asian pivot that most mainstream financial news is ignoring, has just broken that monopoly. We'll look at the commodity markets data that proves the U.S. has lost its leverage and what this structural shift means for energy investing, inflation, and the future of North American power. The massive discovery of 2025 wasn't new oil in the ground. It was a new way out. Welcome to Geo Capitalist. Today's video breaks down how Canada's new oil route is reshaping North American energy and challenging the long-standing U.S. monopoly. If you appreciate clear, independent analysis, make sure to subscribe. To understand the magnitude of this shift, we first need to understand the trap. If you look at a map of North American energy infrastructure from 1980 to 2023, it looks like a funnel. The vast majority of pipelines originating in Alberta point south, feeding directly into the U.S. Midwest. In the industry, this region is known as PADD2, Petroleum Administration for Defense District 2. The refineries in this region, places like Illinois, Minnesota, and Oklahoma, aren't just buying Canadian oil because it's there. They are chemically addicted to it. Over the last 30 years, these refineries spent billions of dollars retooling their heavy crackers and cokers to process a very specific type of heavy, sour crude from the oil sands. They cannot simply switch to light sweet shale oil from Texas overnight. Their equipment isn't built for it. This created a perfect symbiotic trap. The U.S. refineries needed the heavy crude, but Canada had absolutely no other way to get it to global oil markets. This lack of tidewater access meant that Canadian producers had to take whatever price the Americans offered, often $20 to $30 less per barrel than the global benchmark. This differential was effectively a wealth transfer from Canada to the U.S. economy. It kept U.S. gas prices lower and refinery margins higher. For Washington, this was a hidden strategic asset. Guaranteed energy security at a discount, backed by a neighbor who was too geographically isolated to say no. But here is where the narrative flips. While Washington grew comfortable with this monopoly, the data in late 2025 reveals a startling new reality. The U.S. is far more vulnerable than its politicians realize. Recent data from the U.S. Energy Information Administration, EIA, shows that PADD2 refineries are now running on approximately 70% to 73% Canadian crude. They have become so specialized that they are dangerously dependent on a supply chain they assumed they controlled. This is where geopolitics collides with hard physical infrastructure. When people talk about U.S. energy independence, they are usually talking about the Permian Basin and shale oil. They rarely mention that this independence relies heavily on importing millions of barrels a day of Canadian heavy oil to blend with that light shale. Without Canadian imports, the U.S. refining complex in the Midwest would face an immediate catastrophic feedstock shortage. So, while U.S. trade representatives were threatening 10% or 25% tariffs on Canadian goods, they missed the critical detail in the commodity markets. You cannot fight a trade war with a country that controls the tap to your own gas tanks. The U.S. assumed Canada would always be the captive supplier. But in Q4 2025, the utilization rates of these refineries remained high only because the oil kept flowing south. If that flow were to divert even by 10% or 15%, the impact on U.S. oil price forecasts and Midwest gasoline prices would be immediate and severe. The trap was supposed to hold Canada in. Instead, it has locked the U.S. into a dependency they can't easily break. The what-if scenario of Canada diverting oil is no longer theoretical. It is operational. The Trans Mountain Expansion TMX pipeline is now fully online, and it changes the physical geography of the energy stocks landscape. For the first time in history, Canada has a high-volume, dedicated heavy oil pipeline running west to the Pacific Ocean, bypassing the United States entirely. This isn't just about pouring concrete and welding pipe. It is about market optionality. Before TMX, Canadian oil had to pass through the U.S. to reach international buyers, meaning the U.S. could effectively veto exports via regulatory hurdles or transit fees. Now that oil hits the water at the Westridge Marine Terminal in Vancouver. From there, it can be loaded onto Aframax tankers and shipped directly to the highest bidder in Asia, specifically China, India, and Japan. This is the Asian pivot that macroeconomics observers should be watching. We are seeing a structural shift in global trade flows. Refiners in Asia are hungry for heavy crude to replace declining supplies from Mexico and Venezuela. They are willing to pay world market prices, stripping away the captive discount the U.S. has enjoyed for decades. Geopolitically, this gives Canada a kill switch of its own. If Washington pushes too hard on trade tariffs, Canada can simply turn the valve west. They no longer have to sell to PAD 2. They can sell to Sinopec or Reliance Industries. This competition for barrels transforms the North American energy relationship from a monopoly to a competitive open market. Let's look at the specific numbers, because scale is what turns a minor annoyance into a strategic threat. The expanded Trans Mountain system adds 590,000 barrels per day of capacity, bringing the total line capacity to 890,000 barrels per day. To put that in perspective, that volume represents a significant chunk of Canada's total exports. In 2023, the Westridge Terminal was a sleepy corner of the port, loading maybe 1 or 2 tankers a month. Today, in late 2025, we are tracking a tanker leaving that terminal nearly every single day. That is a 30x increase in marine traffic. Every single tanker that leaves Vancouver is carrying approximately 550,000 barrels of oil that is not going to the United States. For the oil and gas industry, this volume is a game changer. It tightens the supply-demand balance in North America significantly. When you remove 500,000 barrels of daily supply from a closed-loop system, prices rise. The differential, that discount we talked about earlier, has already begun to shrink. This means Canadian energy stocks and producers are capturing more revenue per barrel, while U.S. refiners are seeing their margins squeezed. The massive discovery wasn't a new oil field, it was the discovery of pricing power. This 890,000 barrel per day escape valve is the reason why the U.S. can no longer dictate terms. The leverage has physically moved from Washington, D.C. to the shipping lanes of the Pacific. What does this mean for the average American consumer and the broader U.S. economy? First, it complicates the fight against inflation. Global recession fears are still lurking, and energy prices are a primary driver of headline inflation. If U.S. refiners in the Midwest have to compete with Asian buyers for Canadian crude, their input costs go up. Those costs are passed directly to consumers at the pump. We could see a scenario where gas prices in Chicago or Minneapolis decouple from the national average, spiking higher because of this regional feedstock competition. This makes the U.S. Federal Reserve's job harder. It also exposes a critical vulnerability in U.S. national security. Energy security isn't just about how much oil you produce, it's about where your refineries get their oil. By relying so heavily on a neighbor they treated as a vassal state, U.S. planners created a single point of failure. Furthermore, this weakens the U.S. position in any future trade war. If a future administration decides to slap a 25% tariff on Canadian imports, Canada is now insulated. In the past, they would have had to eat the cost. Now, they can just shift more volume to the TMX line. The tariff would essentially act as a self-imposed tax on American drivers, while Canadian oil finds a home in Mumbai or Shanghai. The tariff weapon has been neutralized by steel pipe and ocean tankers. The U.S. is now just one of several customers, and they will have to pay the market rate to keep the oil flowing south. For those of you focused on energy investing and building a resilient portfolio, this shift offers a clear roadmap. The value is migrating upstream. For decades, the easy money trade was owning U.S. refiners who benefited from cheap feedstock. That trade is now crowded and risky. The new opportunity lies with the Canadian producers who have just gained access to global markets. Companies with high exposure to heavy oil production and access to TMX capacity are seeing their realized prices jump. This isn't a temporary spike. It's a structural re-rating of their assets. It also makes Canadian energy a more attractive inflation hedge. Because these companies have long-life reserves and low decline rates, they are cash flow machines. Now that they aren't selling at a discount, that free cash flow is likely to return to shareholders via dividends and buybacks. Conversely, this adds risk to U.S. midstream and downstream companies that are geographically locked into the Midwest. They are on the wrong side of the Asian pivot. Investors need to look at commodity markets not just as a global price, but as a series of regional disconnects. The disconnect that favored the U.S. is closing. Smart money is positioning for a world where North American energy is priced globally, not locally. This is a classic RB trade closing, and the winners will be the ones holding the assets that just got unlocked. Step back and look at the big picture. This story is bigger than just one pipeline. It is a lesson in how geopolitics is ultimately determined by physics and infrastructure. You can have all the political rhetoric you want, but if you can't move your product, you have no power. Canada spent decades building the escape route that Washington said was unnecessary. Now that it is here, the balance of power on the continent has shifted. The United States remains a superpower, but its monopoly over its northern neighbor is broken. We are entering a multipolar energy world, where oil markets are interconnected and leverage is fluid. The Asian pivot ensures that Canadian resources will fuel the growth of the 21st century's emerging economies, whether the U.S. likes it or not. For investors, the takeaway is simple. Never bet against the guy who just found a second customer. The monopoly is over. The open market has arrived, and for the U.S., the era of cheap captive energy is officially history. If you want to understand where the next big shift in macroeconomics will come from, stop looking at the Fed and start looking at the shipping manifests leaving Vancouver. This was Canada's new oil route just broke the U.S. monopoly. If you gained clarity today, I invite you to watch the next video. And if you want to understand how other countries are silently breaking away from U.S. economic dominance, make sure to subscribe and turn on notifications. This channel exists to go beyond headlines and examine how power is actually built, maintained, and exercised over time. Thanks for watching, and I'll see you in the next one.